Welcome back. So, you've brought in a really interesting set of sources today, all looking at, well, the psychology of money, how our minds work when it comes to finance.
Yeah, exactly. And our mission, like always, is to kind of pull out the key ideas, give everyone a bit of a shortcut to understanding how our thinking and, our feelings really shape our financial lives.
It's fascinating stuff. And what really jumped out at me from the materials was this recurring theme
Uh-huh.
that financial success isn't purely about being, book smart or understanding complex markets.
No, not at all. I mean, that helps, obviously.
Yeah.
But the sources really hammer home the role of behavior. Our habits, our emotional responses, they're shaped by our psychology and just, well, the life we've lived.
It almost feels backwards, doesn't it?
Right.
The idea that someone, maybe without any finance background, but who's patient, disciplined, they could actually end up doing better than some, like, financial wizard who can't control their impulses.
Exactly. We tend to treat money like it's um, physics. Clear rules, law.
Like an equation.
Yeah. But it's much more like psychology. It's messy, emotional, full of nuances and biases.
Okay, so let's dive into some of these core ideas. We're going to look at how our personal history kind of creates this unique money lens for each of us.
Uh-huh. And the rules of luck and risk, often bigger than we think.
Yeah, and that difference between getting wealthy versus staying wealthy, apparently two very different skill sets.
Definitely. We'll also touch on compounding, but maybe beyond just the math of it.
Okay. And the idea of enough. That seems really important.
Crucial. Plus, financial independence and just how our emotions can sometimes sneakily drive our decisions.
All right, let's start with this thing the sources call the behavioral gap. We sort of touched on it, the idea that what you do with money often matters more than what you know.
That's the core of it.
Yeah.
There was this anecdote in one article about a really wealthy executive.
Oh, yeah.
Got angry, impulsively threw a wad of cash at a hotel manager or something.
Yeah.
Yeah. Smart guy, successful career, but terrible financial behavior. Ended up broke. It just shows intelligence doesn't equal good money sense.
That's a stark example. And
Yeah.
then the flip side is the story of Ronald Reed, the janitor.
Right. Ronald Reed, janitor, gas station attendant, lived simply, invested patiently for decades.
Ended up with millions, right?
Millions, with zero formal finance training. His story just perfectly highlights that it's often about behavior, patience, discipline, long-term view.
So understanding compound interest is one thing, but actually having the discipline to let it work, especially when markets get scary, that's the real challenge.
That's the behavioral gap right there, knowing versus doing.
Okay, so another thing that really stood out was how our own life story shapes how we see money. Like, we all have these unique filters.
Absolutely. And those filters can be incredibly different. Imagine someone who grew up with very little.
Okay.
Their whole approach to risk, to saving, to opportunity is going to be fundamentally different from someone, say, whose parents were wealthy bankers.
Makes sense. The sources mention things like experiencing high inflation versus stable prices during your formative years.
Exactly. Or living through a deep recession versus an economic boom. Those experiences become these deep-seated anchors in how you think about money, maybe for your whole life.
Kind of gets baked in.
Yeah, it really does. There was that study you found by Malmendier and Nagel.
Uh-huh.
They looked at decades of data and basically found that an investor's willingness to take risks wasn't really tied to their education level or like their IQ,
So what was it tied to?
their personal history.
If you live through big market crashes, you're probably going to be more cautious, regardless of what the finance textbooks say.
Even the big shots recognize this, right? Like Bill Gross with bonds.
Yeah, Bill Gross, huge name in bond investing. He openly admitted that a big part of his success was that his career happened during this long period where interest rates were generally falling.
Which is great for bond prices. Exactly. He basically said if the environment had been different, his whole perspective, maybe even his success, could have been different.
It really shows how the same event, like that 2009 recession,
Oh, yeah?
can hit people completely differently. The overall unemployment rate was, what, 10%?
Around there.
Yeah.
But for some groups, like young, less educated black men, it was closer to 50%. 50.
That's staggering.
While for others, maybe older, college-educated white women, it stayed closer to 4%. So you have these vastly different realities of risk and opportunity all happening at the same time.
And understanding that helps explain things that seem well, illogical, like lower income folks buying lottery tickets.
Right. From a purely rational spreadsheet point of view, it looks crazy. The odds are terrible.
Yeah.
But if you consider their circumstances, maybe the lottery ticket isn't just about the money. Maybe it represents the only tangible sliver of hope they feel they have for a drastically different life.
A hope that wealthier people might already take for granted.
Precisely. It's like an investment in a dream, maybe the only dream that feels accessible. It just underlines how financial decisions are so wrapped up in our personal stories, our hopes, our fears, not just numbers.
Okay, let's shift gears a bit. Luck and risk. The sources seem to say it's really hard to tell where skill ends and luck begins in finance.
It's incredibly fuzzy. Robert Shiller, the Nobel laureate, asked this great question. What parts of investing are just unknowable? It points to that inherent randomness. And we have this tendency, don't we, to downplay luck when we see others succeed. Maybe it's envy.
Or maybe, for ourselves, admitting luck feels like it diminishes our own effort.
Could be. It's tricky. The sources mentioned that brothers tend to have incomes that are more similar than their heights or weights are similar.
Really? Suggesting background matters a lot.
Hugely.
Yeah.
Socioeconomic background, family advantages. But people rarely highlight that when telling their own success story, you know?
Yeah, it's usually about hard work and smart decisions.
Right. And think about a stock investment. Say you buy something, and 5 years later, it's gone nowhere.
Or is that a bad decision?
Or just bad luck.
Exactly. Maybe it was a perfectly reasonable bet that just didn't pan out because of things outside your control. We prefer simple stories, though. Good decision, good outcome. Bad decision, bad outcome. Risk messes that up.
The Vanderbilt example was interesting, too. Cornelius Vanderbilt built an empire, but some of his methods were questionable, aggressive, maybe illegal sometimes.
Definitely pushed the boundaries, and it worked out for him massively. But you can easily imagine a slightly different turn of events where bold becomes reckless and he ends up ruined. The line is thin.
And Benjamin Graham's Geico investment.
Oh, classic story. Graham, the father of value investing, preached diversification above all else.
Right. Don't put all your eggs in one basket.
But then he makes this hugely concentrated bet on Geico, which makes him incredibly wealthy. It completely violated his own rules.
So was it genius insight or just getting lucky on that one? Even Graham seemed unsure. It makes you question how much we can really learn from these extreme outlier successes.
So the takeaway for us listening is maybe don't try to be the next Warren Buffett. Focus more on general principles.
That seems to be the advice. Understand the broad patterns of what works and what fails for most people over time. Trying to replicate extreme genius or extreme luck is probably a losing game.
Bill Gates' quote comes to mind, "Success is a lousy teacher."
Perfect. It can make you complacent, make you ignore the role luck might have played. Being humble when you win helps you remember risk is always lurking.
Which ties nicely into the next point. Getting wealthy versus staying wealthy, they're different skills.
Totally different. The key word for staying wealthy, according to these sources, is just
The survival.
survival.
Yeah. Think about it. The aggressive risk-taking that might build a fortune quickly could be the very thing that destroys it later. Staying power requires something else.
The stat about how many public companies eventually fail, lose almost all their value, was eye-opening. It's something like 40%.
Yeah.
It shows how hard long-term survival is, even for established businesses.
Michael Moritz from Sequoia Capital,
Mm.
the venture capital firm.
Right. He said something like, their success comes partly from always being afraid of going out of business. That constant paranoia prevents complacency.
Keeps them sharp.
Exactly. And you need that long-term survival for compounding to really work its magic. Compounding needs time, decades even, and that means weathering all the storms along the way.
So just avoiding the big mistakes.
Can be way more important than chasing the absolute highest returns, like having enough cash so you're never forced to sell your stocks during a crash. That alone can make a huge difference to your long-term wealth.
It's about planning, but maybe even more about planning for things not going according to plan, having that buffer.
That's it. Room for error, margin of safety. Look at the last 20 years, 9/11, the financial crisis, a global pandemic.
Yeah, who saw all that coming?
Nobody. So a plan that only works if the future unfolds exactly as predicted is fragile. A robust plan survives surprises. It keeps you in the game.
And staying in the game is how you let compounding do its thing.
Precisely.
Okay, let's talk about enough. This seems like a really deep, almost philosophical point in finance.
It really is. The anecdote about Kurt Vonnegut and Joseph Heller is fantastic.
Remind me.
They're at a party hosted by some billionaire. Vonnegut points out that the billionaire maybe made more money that day than Heller had earned from Catch-22 in its entire existence.
Wow. Okay.
And Heller just says, yes, but I have something he will never have. Vonnegut asks what? Heller says, enough.
That hits hard because you contrast that with Rajat Gupta, Bernie Madoff.
Yeah, guys who had insane wealth,
Huh.
more than they could ever need.
And they risked it all. Reputation, freedom, everything for more.
More money they didn't have and didn't need, as
Yep.
Buffett put it. They risked what they did have and did need. Foolish.
So the hardest financial skill, maybe.
Getting the goalpost to stop moving.
Yeah. Resisting that urge for just a little bit more, especially when it means putting the important things at risk.
Things like reputation, freedom, family, love, happiness. Those things are invaluable. Knowing you have enough money is what protects them. It's not about limiting ambition. It's about safeguarding what truly matters.
Let's switch to compounding again. You mentioned it's more than math. The sources use an analogy. Ice ages.
Yeah, I like that one. Ice ages don't happen overnight. They happen because of tiny incremental changes in temperature sustained over thousands, millions of years.
Small changes, huge results, given enough time.
Exactly. That's compounding. It's not intuitive. And Warren Buffett is the poster child.
The ultimate example.
It's staggering, but something like 99.9% of his net worth came after his 50th birthday.
Wow. So it wasn't just about being a brilliant investor.
It was about being a pretty good investor consistently for an incredibly long time, decades upon decades.
You contrast him with Jim Simons, the hedge fund guy.
Right. Simons has generated much higher annual returns, phenomenal numbers.
But he started later.
Started later, so even with those higher returns, his total wealth is significantly less than Buffett's. It just powerfully illustrates the role of time. Good returns sustained for long enough beat great returns over a shorter period.
Our brains don't naturally grasp that exponential growth, do they?
Not easily.
Right.
You think linearly. The example of data storage growth was good too. How much more data we can store now compared to, say, 30 years ago. It's mind-boggling. Exponential.
And the stories from the 1929 crash, Jesse Livermore, Abraham Jermansky.
Yeah, cautionary tales again. Both were hugely successful initially in that boom. Made fortunes.
But they didn't keep them.
Nope. Wiped out. Overconfidence, too much leverage, couldn't handle the downturn, couldn't manage the risk. They got the getting wealthy part right, but failed at the staying wealthy part. Didn't let compounding work long term.
This leads into another subtle point, being rational versus being reasonable in finance.
Yeah, this is really interesting. A purely rational decision might be what a spreadsheet says maximizes your theoretical return. But a reasonable decision acknowledges that we're human. We have emotions, fears, real-life constraints.
Like Harry Markowitz, the Nobel Prize winner.
Exactly. He figured out the math behind optimal portfolio allocation, but for his own money. Initially, he just split it 50-50 between stocks and bonds. He said it was to minimize future regret. It wasn't necessarily the mathematically perfect split based on his theories, but it felt comfortable to him. It was reasonable, emotionally speaking.
That makes sense. You have to be able to sleep at night with your strategy.
Right. And think about the opposite. Someone gets wiped out using huge leverage. Rationally, maybe the math still says leverage is optimal going forward.
But could you actually do that again psychologically after being ruined?
Probably not. It might be more reasonable to adopt a less optimal strategy that you can actually stick with long term without freaking out. Staying in the game is key.
The sources mentioned other examples, like maybe owning mostly stocks from your own country. Home bias.
Yeah, rationally, maybe you should be more globally diversified. But if owning familiar companies helps you stay invested, maybe it's reasonable. Or even dabbling in a few individual stocks for fun, if it keeps you engaged with your main sensible portfolio.
Even Jack Bogle investing in his son's higher fee funds.
Right, Bogle, Mr. Low-Cost Indexing himself. Rationally, he should avoid high fees. But reasonably, maybe supporting his son felt more important in that specific instance. It shows personal factors matter.
Okay, let's talk about pessimism. Why does it seem like bad news about money always gets more attention and sounds smarter?
It's kind of a quirk of psychology, isn't it? Pessimism often sounds more intellectual, more cautious. Optimism can sometimes come across as naive.
Like you're not seeing the risks.
Exactly.
Yeah.
But the optimism the sources advocate isn't blind faith. It's based on the long arc of history. Progress happens, standards of living tend to rise, even with massive setbacks along the way.
And money is so universal. Bad financial news feels relevant to everyone.
Instantly. A market crash, inflation, it affects us all. Progress, on the other hand, is often slow, gradual, almost invisible day to day.
Like that newspaper in 1889 saying airplanes were impossible.
Hilarious in hindsight. But it shows how easy it is to focus on current problems and underestimate future potential.
Setbacks are sudden and dramatic crashes, crises. Growth is slow and steady compounding, so the negative stories are just easier to tell, more compelling.
I think so. They grab headlines. The thought experiment about the alien visiting New York was great for this.
Right, visiting in 2007, things look great. Visits again in 2009, markets crash, mood is terrible.
But the actual buildings, the infrastructure, the people skills, the underlying capacity of the economy probably hasn't changed that much. The narrative changed more than the reality in some ways.
And that fear, that pessimism can make people vulnerable.
Absolutely. Vulnerable to extreme predictions like that Russian professor predicting the U.S. would break apart, or vulnerable to schemes like Madoff's. Fear makes people grasp at straws.
Okay, last main psychological bit. This idea of stories and the illusion of control. Our brains just want explanations.
Yeah, we're narrative machines. We need things to make sense. Even a toddler creates simple stories to explain complex things they don't understand.
But we need to be careful applying that to things like the economy or the stock market.
Exactly. Sending a probe to Pluto, that requires incredible precision. Predicting next year's stock market returns. That's a field full of uncertainty, not precision. Precise forecasts are often an illusion of control.
But understanding the stories people tell themselves about money, that's still important.
Crucial. Even if the stories aren't perfectly rational, they drive behavior. Understanding those narratives helps understand financial markets and individual actions.
So, pulling all this together,
Yeah.
what are the big takeaways for actually making better financial decisions, knowing all this psychology?
Well, first, humility. Recognize everyone's situation is unique. Don't just copy others. Their game might be totally different from yours. Different time horizon, different risk tolerance.
Okay, know yourself.
And acknowledge luck and risk. Focus on what you can control. Your savings rate, your own behavior, your spending. Saving is key. It's the gap between your ego and your income, as one source put it. Wealth is what you don't see.
Like the unspent money.
Right. Save just to save. Build that buffer for surprises. Don't always need a specific goal for every dollar saved.
And accept the price of investing, the volatility and uncertainty.
Yeah, see it as an admission fee for potential long-term returns, not a fine or a penalty when things go down. Trying to avoid that fee usually means missing out on growth.
Build in room for error. Don't aim for the absolute razor's edge optimum.
Exactly. Endurance matters more than temporary brilliance. That margin of safety lets you endure.
Avoid extremes. Don't go all in on one thing.
Pretty much. Balance helps you avoid massive regret if things change, or if you change later in life. And don't cling to old goals just because you started them. No sunk costs in life planning.
Be wary of bubbles. Understand they're about short-term momentum and psychology, not just long-term value.
Right. Don't get sucked into games you don't understand. And remember, pessimism's pull, but trust the long-term trend of progress. Be a possibilist.
Use history as a guide, but not a perfect map, because things do change.
Precisely. Avoid both the history repeats exactly trap and the this time it's completely different trap. It's usually somewhere in between.
Think like a card counter. Know the odds, manage your bets, leave room for error.
That's a great analogy. And ultimately, strive for financial independence. That ability to control your time, do what you want, when you want, with whom you want, that's the real prize money can buy.
You also included some history on consumerism, which adds context. How did we get these modern expectations about spending and debt?
It's interesting. A lot ties back to the end of World War II. There was huge pent-up demand, and policy deliberately encouraged spending low interest rates, easier consumer credit.
To get the economy going.
Exactly. And it worked. The 50s and 60s saw this big economic boom, and importantly, incomes were relatively equal compared to now.
So lots of people felt they were moving up together.
Yeah, lifestyles sort of leveled up across a broad middle class. That period created a baseline expectation of what a good or normal life looked like.
But then things started changing in the 70s, 80s.
Right. Growth became more uneven. Incomes started diverging more significantly. You got a wealthier segment pulling away.
But the expectations maybe didn't change as fast.
That's the idea.
Yeah.
Many people still held on to those expectations formed in the more equal post-war era. And as the lifestyles of the wealthy became more visible,
Through media, etc.
it perhaps influenced aspirations. People started stretching, maybe taking on more debt, to try and maintain that perceived standard or keep up.
So even though the economy changes, those older expectations can linger and affect behavior today.
Seems likely. It adds another layer to understanding why people make the financial choices they do.
Okay, so wrapping this deep dive up, it's really clear that managing money isn't just about numbers. It's this ongoing process of understanding ourselves, our biases, our history.
Absolutely. It's a journey of self-awareness, really, and adapting as the world and we ourselves change.
So maybe a good exercise for everyone listening is to just reflect. Think about your own experiences with money. How might they be coloring your decisions right now?
Yeah. Are your goals truly your goals? Or are they maybe influenced a bit too much by comparing yourself to others?
Good question.
Yeah.
And maybe a final thought to leave everyone with. Now that we've considered how powerful our own psychology and history are, what's maybe one financial belief or habit you have right now that might be worth examining a bit more closely?
That's a great reflective question. Thanks for joining us for this exploration into the psychology of money. Hopefully it gives everyone some useful perspectives for their own financial journey.